Okay, so welcome to the deep dive, everybody. Today,
Yeah.
we are going deep on mortgages.
Yes, we are.
Specifically, we're looking at, that question a lot of people in Switzerland are asking themselves, should I go for a SARON mortgage or a
Yeah.
10-year fixed rate?
Right. Yeah. Huge decision.
It's a huge decision. And, we've been looking at reports about the Swiss mortgage market, and,
Yeah.
we've been pulling data on interest rates from all the big players.
UBS Post Finance.
UBS Post Finance, Money Park, Comparis, all of them.
All the big ones.
And we've got economic forecasts from the S&B and SECO.
Right.
So
The big picture.
yeah, so we're going to try to break this down into the stuff that's going to matter to you
Absolutely.
when you're making this decision.
Yeah.
So
Should we start with SARON?
yeah, let's start with Saron. What is it?
Okay, so SARON, it stands for Swiss average rate overnight.
Okay.
And this is basically the rate that banks use to lend money to each other overnight. So it changes every single day.
Oh, wow.
Yeah, so it's a variable rate.
Okay.
And if you get a SARON mortgage, your rate is going to be adjusted every 3 months.
Every 3 months.
Yep, based on this thing called the compounded SARON.
Okay.
So, why is everyone talking about SARON right now?
Right. Why is it such a hot topic?
Well, the SNB, the Swiss National Bank, they just cut the policy rate in March
Okay.
down to 0.25%.
0.25%.
So that has had this knock-on effect
Okay.
where initial SARON rates have come down quite a bit.
Okay, so they're lower.
Right, like
Yeah.
UBS Key 4, their rates start at 0.96% plus SARON.
Plus Saron.
Right, Post Finance starts at 0.79% plus SARON.
Wow.
Money Park about 1% plus SARON.
Okay.
And these are for the 3-month terms.
Okay.
Now, the SARON fixing rate was around 0.43 to 0.45% in the middle of March.
Okay, so we're talking like
Yeah, it's a good
pretty
tone.
low starting cost potentially
Right.
with Saron.
Exactly.
And there's also the potential, like, if the rates fall even further,
Oh, yeah.
you'd benefit from that.
Yeah, you could win big.
And also some flexibility to, like,
Oh, absolutely.
switch later on if you wanted to.
You can often convert to a fixed rate with SARON mortgages.
Okay.
Often quarterly, you can do that.
Quarterly. Wow.
But there's a but.
There's always a but, right?
Right.
You have to understand the other side of the coin.
Okay.
Like, what are the risks here?
Right.
The big one is interest rates could go up.
Okay.
And if they do, your payments will go up too.
Right.
You just don't know how much you're going to end up paying overall.
Okay, so that's the uncertainty.
Exactly.
You've got to be comfortable with that.
Right. And Saron mortgages,
Uh-huh.
they usually don't have a fixed end date.
So they just go on forever.
Yeah, they just keep resetting every 3 months.
Oh, wow.
Yeah. But I think Post Finance actually has like a 3-year term.
Okay.
That's a little different.
So that's an exception.
Yeah, that's an exception.
Okay, so basically cheaper potentially up front.
But the potential for things to change.
Yeah, the roller coaster ride.
A little bit of a gamble maybe.
Right.
Okay, so let's talk 10-year fixed.
Okay.
Stability.
Stability. What's the biggest advantage there?
So you know exactly what your interest rate is going to be for 10 years.
You lock it in.
Yeah, you lock it in.
You know what you're paying every month.
You can budget, you can plan.
And that seems really attractive when like rates are low.
Yeah.
And you think they're just going to keep going up.
Exactly.
Yeah.
You're protecting yourself from those future increases.
Okay, so what are we looking at like rate-wise right now?
So UBS Key 4, they've got rates starting at 1.7%.
Okay.
Post Finance, 1.9%.
Got it.
Money Park is a little lower, 1.59%.
Okay.
And, you can shop around on Comparis too.
Uh-huh.
They've got a best offer at 1.65%.
All right, so pretty similar.
Yeah.
Ballpark.
Okay, so we've got security,
Mm-hmm.
predictability,
Mm-hmm.
but potentially higher starting rates.
Yeah, that's the trade-off.
And less flexibility.
Right, because if rates fall,
You're stuck.
you're stuck. You don't get to enjoy that.
And if you break the term early,
Yeah.
you usually have to pay penalties.
Right, those can be hefty.
So it's a commitment.
Yeah, 10 years is a long time.
It is a long time.
But you can actually get fixed rates for other terms, too.
Really?
Yeah, like 2 years, 5 years, even 15 or more.
Wow. Okay. So there's options out there.
There are options.
But, okay, so we're talking Switzerland.
Yeah.
We've got this, low interest rate environment
Mm-hmm.
because of the S&B.
Right. They've been cutting rates like crazy.
Yeah, 0.5% in December 2024.
Uh-huh.
Then another cut to 0.25% in March.
March 2025, yeah.
And inflation is super low.
Yeah, like 0.3%.
And they're expecting the economy to grow,
Obviously.
modestly this year, like 1.5%.
Yeah, something like that.
So it's like,
It's tricky
it's a tricky time to be making this decision.
because you've got that lower cost up front and the flexibility of SARON
Right.
versus the security of
The safety net.
Yeah, safety net.
So what are the experts saying?
Well, it's interesting because even with SARON rates being lower, some institutions like post-finance, they're actually leaning towards fixed.
Wow.
They're thinking that even if rates go up a little bit, that might eat up all the savings you get from starting with SARON.
Right.
If you want that long-term budget stability,
Okay.
fixed might still be the way to go.
So they're thinking ahead, long term.
Right.
What about other experts?
Well, comparative, they're really emphasizing that risk tolerance thing.
That makes sense.
How much risk are you comfortable with?
How much are you willing to gamble?
Yeah, exactly.
Okay.
So it really comes down to the individual.
Okay, so what are the questions our listeners should be asking themselves?
Well, first off, how comfortable are you with your mortgage payments potentially changing?
Up and down every 3 months.
Every 3 months, yeah. And, what's your overall financial situation?
Yeah. How stable are you?
How stable are you?
How secure is your job? All that.
Exactly. And then, how long do you realistically see yourself staying in this property?
Yeah.
Are we talking 5 years, 10 years?
Longer even.
Longer? Who knows?
Oh, yeah.
And then you have to think about your long-term financial goals.
Yeah. What are you trying to achieve?
What are you saving for retirement kids' college?
Okay.
And finally, and this is the big one, what do you think is going to happen with interest rates?
Over the next 10 years.
Over the next 10 years. Yeah, because nobody knows for sure.
Right. The crystal ball's a little foggy.
It is very foggy.
But you've got to have some kind of idea.
Some kind of gut feeling.
Okay, so no easy answers here.
No.
Yeah.
But hopefully, we've given you some stuff to think about.
A framework.
Yeah, a framework.
To make this decision.
Right, because ultimately it's a personal one.
It really is.
It depends on your comfort level with risk.
Versus security.
Yeah, exactly.
Okay, so before we wrap up, I want to leave our listeners one final thought. Given that rates are so low right now, and they could go up later.
Potentially.
What matters more to you?
Yeah.
Saving money right now.
Up front.
Or having that peace of mind. Knowing your payments aren't going to change.
For 10 years.
For a decade.
Yeah, that's the big question.
That's the question.
Figure out what's more important to you.
And go from there.
And then you can really start digging into the details.
Exactly. All right, that's all the time we have on the deep dive today.
Great talking with you.
It's been a pleasure. Thanks for joining us.
See you next time.
See ya.